Hello, what I'm going to show you today is a portfolio of positions that I actually have. I'll discuss some of the reasonings behind why I bought them or the logic behind it, and then in future updates, I can reference back to growth or losses. When I was trying to track portfolios, I found that a lot of the tools out there are geared more towards businesses with predictions and stuff like that, or financial advisors. A lot of the apps for a mobile had restrictions on the number of tickers you could add, or generally had a paywall where to get the full features you needed to pay quite heavily. But there was a tool, I think, on Morningstar that allowed you to track things, and it was meant to be really good. But by the time I tried to sign up and use it all, it had been replaced. And basically, I don't know whether they sold out or, but it became like a pay tool. But then I came across one that I've used in the past, but didn't realise the depth that it offered. And that was using the finance portfolio tool via Yahoo Finance. So as I said, there are loads of options out there, but a lot of them seem to be subscription models and more geared towards financial advisors or for offering services to other people, such as modelling. I believe the Yahoo Finance portfolio is the best free tool, hence me using it. It also has the mobile companion. The idea behind the portfolio is to invest in multiple positions and then be able to track it without additional revenue. I'm wanting to show the transparency, so if people are on the fence of investing and that, they may get involved. Please remember though that this is not financial advice. This is my own personal opinions and thoughts, and you need to do your own research or have your own feelings. Don't just follow anyone else blindly. So the first position I've got is iShares FTSE 100 ETF, and it's an accumulating account, which basically means any dividends that it gets are reinvested automatically. If you're required to do tax returns, then accumulating account can cause problems because you've got to declare the dividends received in a financial year. All these graphs are on Yahoo Finance, and I'll do a link in the description. Another takeaway from the graph is, as you can see, it gradually goes up. So when you think about the markets and that and inflation, I believe that the inflation is baked in to the stock market. So in a way you're protected. And I believe the fear of losing out is what the people who invest want to keep the riffraff out type thing. So if we bring it up to the last year, we can see the effect that the Iran war has delivered, and the uncertainty of what's happening makes, the lemming syndrome of people dumping because the fear of missing out. Then there's the recovery, so people jump back in. So it could take months, it could take years to recover, but you can see here that it happened in February, and it was pretty much back mid-April. But obviously the cost, the fear of the fuel crisis, that's what made the dips, and then the fear of inflation catching on. So part of the reason that I have a position in the FTSE 100 is because it includes dividends basically, and I believe that it's about 3 to 3.5%, I think, in dividends for the FTSE 100, which basically softens the blow in times of disruption, where if a market doesn't track or doesn't pay out dividends, the drop is going to be more significant, but the dividends can give you like a bit of breathing space. But obviously overall, the other markets could have a better year-on-year return. So it depends on your appetite for risk, I suppose. The next position I have is a world index, and this is a distributing one. It gets about a 1.3% dividend. So I think either twice a year or once a year you'll get a dividend. The main advice from everyone seems to be a globally diversified portfolio, and the world ETFs accomplish this. My first proper shareholding, HICL Infrastructure has a lot of positions in hospitals and projects, so they are an infrastructure based company. And because of that, a lot of their cash flow is linked to interest rates. So you can see from 2015 to 2022, the interest rates were very low, so the company profited. A certain war happened from 2022, and that affected the interest rates, which went up, and inflation went up. So their profitability reduced and their favoritism dropped. Part of the reason it's in my portfolio is because it's infrastructure, and that is classed as more of a safer bet during disruption or potential drops. Part of this is part of the long-term contracts with hospitals or other government things. Now, because of the drop, there's an opportunity for an upside where it may return to the previous figures. Another advantage is that it pays out about a 7% dividend, and that's what attracted me to investing into HICL Infrastructure. Likewise, Kia Group is an infrastructure business and has a lot of government contracts. As you can see from the graph, there was a very strong performance for 15 years before COVID hit. So I saw this as another buying opportunity. Although my position isn't massive, if I happen to have gone all in, I'd be very happy now. But that's the gambles that you take on the stock market. So my last actual share is with EasyJet. The logic that I had behind EasyJet was I thought post-COVID they could recover to £10 a share. So I originally bought in at about £5 a share, and due to the potential fuel shortages, it has dropped to about £3.50. So I have bought some more. They also pay a decent dividend. As with all shares, it is a risk-reward situation. To quote Warren Buffett, be fearful when others are greedy, and be greedy when others are fearful. Now, as a warning, I just want to include that I did have a position in Cineworld, and you may notice that they aren't on the stock market anymore. And I lost about £3,600 when they basically went into administration. So not every gamble pays off. Right then, let's have a look at the portfolio on Yahoo Finance. So once you've signed in, you can click on the finance on the top banner. It's just off screen, so I can't show it, but then after you've signed into the finance, on the top left there's a My Portfolio, and this is where you land on this screen, which shows your positions and stuff. I've transferred the data from here onto a spreadsheet so I can talk a bit more about where it's from and that. But you can see this is the actual costings of what I had to pay to buy in. There's also a cash of 25,000 here, and that is actually in premium bonds, and I'll talk to that on the spreadsheet in a minute. So as I mentioned, the total cost column is here, and that's what I've paid, and that's the current market value. But unless you sell it, you can't lock in your gains or losses, and that is why it is an unrealized gain over this side, and this is saying what each one is currently at. Now, yes, you can see here that EasyJet is operating at a loss, but you can see that because of the dividends that has been received, that's not included in the total because it's been paid out. So technically it's in positive territory. You also get more information such as the dividends that are due soon, how your portfolio is allocated, the sector information breakdown, and then portfolio news for what's in your portfolio. I've lifted the data from Yahoo Finance and I've put it into a spreadsheet so I can do more calculations and show things. You may notice that the figures are slightly different, and that's because when I took them, it may have been throughout the day when it was fluctuating. My total cost of investment has been £101,017.25. It currently has a value of £112,805. But what that is not including is the dividends that have been received. And as I was mentioning before for EasyJet, although I'm posting a loss, with the dividends, it's actually positive territory. And then there's the upside if things improve post the Iran fuel issues that are going on. Regarding the dividends, I did want to clear up the actual rates that I just got in. Obviously, the FTSE 100 was an accumulating account, but there's an equivalent distributing account, which ticker is ISF, and that's currently paying 2.83%. Now, I did say it was 3 to 3.5%, so it shows you that the market dividends have been dropping, but that could be because we're transitioning into more of a growth phase, or they're protecting from tax raids from the government, so they'd rather reinvest profits than distributing them to investors. It may also be an adjustment due to the weakness or strength of the pound on global markets. So as I mentioned, the gains that I received from the shares value rising, there was also the dividends that I received, and that's the £3,028 in dividends. If we talk it as 100,000, that's 3%. This 4,200 figure is because of the premium bonds winnings have been included. But as they have gone into the market value, I haven't included them in this calculation. Overall, I have gained £14,800 from the investments, which is a 14% with dividends, or 11.6% without. Now, that return would sound great if it was just over a year, but in reality, these investments have been dripped in over a number of years. So as a cash equivalent, I used the Bank of England base rate and the years and the values I had invested during those years. And I've calculated the interest added, and that carried over to the following year, and so on and so forth. Had I put it in a cash investment, the portfolio would be currently worth 106,422, which would be an accumulated return of 5.35%. But considering I was getting 11.6 without dividends and 14.6, was it? 14.67 with dividends, you can see that the investments beat the cash. Now, regarding the premium bonds, I've tracked the rates that they associate with the prize fund, and that's generated the expected winnings, and this is the actual return I received, which works out at about 4.6%. I'm running these years April to April because of the tax year, and this would be the expected breakdown of a per month winning, and only 1 month really has gone by. May is about due, so I'm about £60 behind the headline figures. Part of my thoughts behind the premium bonds is that the winnings are tax-free, so unless you are already getting interest over £1,000, then it's probably not worth doing. But like the lottery, there is a chance of winning a high value prize, and I wanted to track and see what actually it does pay out when it's calculated. So what I'm showing now is basically the bank rate for the last 10 years. And as you can see, before 2022, it was basically below 1%. And this low historical percentage is interesting because the outcry of Rachel Reeves dropping the cash ISA amount to 12,000, as you can understand the logic of trying to get people more to invest than put it in cash. So to close this off, the portfolio initial investment was 101,000 and it's now worth 114.8. Now, as the majority of the investment was in the last year or two, we'll just draw a line under to say that that's like the baseline of 1 year, and that'll make it easier to track the changes. If you do have any questions or thoughts or want to offer advice, feel free to add a comment and hopefully we can learn and grow together. Thank you for your time. I've made another video here if you want to know why fear is used to manipulate you.